Have you ever wondered if a brutal business loss this year could actually turn into a massively valuable asset to save you taxes next year? Well, for all the tax pros, CAs, and business owners tuning in today, the answer is a resounding yes. Welcome to this explainer on the new Income Tax Act 2025. Today, we're unpacking the exact mechanics of turning those painful financial setbacks into real future tax relief. Let's get right into it.
Look, if you or your clients took a hit and incurred a business loss, Chapter 7 of the ITA 2025 is literally your ultimate survival guide. Specifically, we're talking about sections 108 to 121. These sections are your definitive roadmap for adjusting those losses against taxable income. Now, the Act itself is new, sure, but the foundational principles here, they offer a really seamless continuity from the old regime, just with some much-needed structural clarity. So, let's explore how this all works. Here's our quick roadmap for today's explainer. 1. Chapter 7, an introduction. 2. Core set-off provisions. 3. Carry-forward limitations. 4. Transition from the 1961 Act. 5. Practical example and compliance. And finally, 6. Summary and key takeaways.
Okay, kicking things off with Part 1, Chapter 7, an introduction, specifically looking at the objective and applicability of Sections 108 to 121.
Moving on to Part 2, Core Set-Off Provisions, where we'll be understanding intrahead and interhead adjustments.
So, the whole point of Chapter 7 is to give taxpayers a systematic, step-by-step mechanism to offset financial setbacks before computing that final tax bill. The core architecture? It's practically identical to the old law. It all kicks off with Section 108 for intrahead adjustments. Basically, you're adjusting a loss from one source against income from another source as long as it's within the exact same head of income. Now, if you still have a loss remaining after that, we move to Section 109 for interhead set-offs. This lets you adjust that leftover loss against income under a completely different head. But, and this is a big but, you can't just offset anything against everything. Section 109 has some strict limitations built right in. For example, if you've got a house property loss, your interhead set-off is hard-capped at 2 lakh rupees, period. Also, a business loss absolutely cannot be set off against salary income, no way. And don't forget capital gains. Capital losses are strictly ring-fenced under Section 109 too. They cannot be set off against any other head of income whatsoever. They've got to stay right there within the capital gains family.
All right, Part 3, Carry-Forward Limitations. Let's look at the time limits for carrying forward unabsorbed losses.
So, what exactly happens when a loss is just so massive it can't be fully absorbed in the current tax year? Well, let's walk through this matrix to see how you carry those unabsorbed losses forward into future years under Sections 110 through 115. The good news? The statutory time limits from the old 1961 Act have been retained perfectly. Under Section 112, a regular business loss can be carried forward for 8 years. Capital losses under Section 111? They also get that nice 8-year window. But keep an eye on speculation business losses under Section 113. Those are restricted to a much shorter 4-year period. It is absolutely vital for us tax planners to track these timelines like hawks, so those sweet tax benefits don't just expire unused.
Next up, Part 4, Transition from the 1961 Act. How we're migrating old losses to the Income Tax Act 2025.
Okay, it's time to address the elephant in the room. What in the world happens to those losses you already racked up under the old law before April 1st, 2026? Well, to make sure this transition is smooth, the government gave us Section 536. This is your vital savings clause that decides the ultimate fate of your unabsorbed losses from the 1961 Act. As you can see mapped out here, Section 536, subsections 2, M, and N, explicitly protect those old losses. They keep their original nature, so a business loss stays a business loss, and they keep their original time limits. But here is the catch. Eligibility is strictly determined by the old law, meaning that original loss return must have been filed on time under Section 139(3) of the old Act. If you file that old loss return late, the 2025 Act cannot save you. That defect can't be cured, and the loss is going to lapse.
Let's move to Part 5, Practical Example and Compliance. Applying the law and meeting your filing requirements.
Look, theory is great and all, but how does a tax pro actually apply this stuff to a client's portfolio in the real world, especially under the new tax year terminology? Let's break it down into a standard 3-step process using a quick hypothetical. Imagine your client has a business loss. Step 1, under Section 108, we try to offset this against any other business income they might have first. Step 2, if a loss is still sitting there, we apply Section 109 to offset it against other heads, like house property or other sources, making sure we absolutely don't touch salary income. Step 3, any remaining unabsorbed balance is just carried forward under Section 112 to the next tax year. It's a very logical, sequential flow.
But to actually use these steps, your compliance has to be totally flawless. Under Section 121 of the new Act, if you fail to file a loss return by the due date, you completely forfeit your right to carry it forward. Period. Also, under the Income Tax Rules 2026, if you're dealing with an amalgamated company and trying to carry forward the old entity's losses, you literally must file Form 29, and it has to be certified by a CA to prove you're keeping up the prescribed production levels. Guys, accurate documentation here is completely non-negotiable.
Actually, before we wrap up, I need to point out a massive practical pitfall that catches so many professionals off guard. Under Section 119, if a partnership firm's constitution changes, let's say a partner retires or sadly passes away, the proportionate share of the firm's loss tied to that specific partner completely lapses. It cannot be carried forward by the newly reconstituted firm. This is such a common misunderstanding during partnership transitions, so please flag this immediately for your advisory practice.
Finally, Part 6, Summary and Key Takeaways. Let's do a final review of Chapter 7.
We have covered a ton of dense legal ground today, from Sections 108 to 121, set-offs, carry-forwards, transition rules, the whole shebang. So here's what you really need to take away from this. First, the core sequence of intra-head then inter-head adjustments, identical to the old law. Second, Section 536 is your safety net. It fully protects your validly filed 1961 Act losses. Third, timely filing of that loss return is an absolute prerequisite. If you miss the deadline, you lose the benefit. And finally, the statutory carry-forward limits of 4 or 8 years remain entirely unchanged. So while this act is completely new, the foundational principles offer you absolute continuity. The mechanics haven't changed, but with these new transition rules, you really have to ask yourself, is your firm's documentation robust enough to guarantee your clients won't lose their past deductions in this entirely new era?
Thank you for watching. Please like, subscribe, and share. Disclaimer: this video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.